In this video, I will cover the federal debt. In this slide, I outline the rate of growth of debt for each recession. So you can see from the 1980s to the 1990s, the rate of the debt growth from that period. And you can see from around 1990 to 2000, it went from about 4 trillion to about 6 trillion. And then once it reached 2008, you can see it was about 9 trillion. And then that's when it started increasing a whole lot more. Now you can see the from 2008 to 2021, 2020, you can see that the rate of the growth has been exponentially greater, and it's going a lot further since between recessions. So I feel like there's a bubble building with the debt, and I just wanted to kind of go over that, and I'll also kind of mention the factors involved as far as money supply and how that's propping things up. But in this chart, you can see it also starts in 1980. But you can see here where the rate of the growth of the debt was fairly consistent, and then it moved up a lot more rapid once 2008 hit. So that's a indication that we're moving into debt a lot faster than what we were, which is not exactly a good sign. So in this chart, you can see that the chart is showing from around 2008 to 2020, and the debt in 2008 in the second quarter was 9.4 trillion. And once we got into 2020, we were at it was 26.9 trillion. So it went from 9.4 to 26.9. So that's quite an increase. On this chart, you can see that we accumulated an additional $17 trillion from 2008 to 2020 over the 13-year period. And that would average out to about 1.34 trillion a year. And it's kind of crazy to think about, because if we continue on this pace, 100 years from now, we'll be $100 trillion more in debt if something doesn't change. So currently, at today's debt, we're at 27 trillion. If we continue a trillion a year, we'll be at 127 trillion in the year 2121. So that's certainly not something I would want to see. But going back to this chart, it looks like a bubble is building between these two recessions of 2018 and 2020. And the market was crashing in March 2020. And now that we're in 2021, the markets have been reaching all-time highs. And there's a lot of things involved that I believe, but as far as like stimulus packages, low interest rates, but a big part of that is the money supply that was added. So if we go over here and we take a look at the M1 money stock, once you look at around the 2020 range, that's when we put on about a little over $2 trillion worth of debt. And to put that in perspective, over 1 year, we added 2.8 trillion. But if you look at October 2011 and you go all the way up to January 2020, that 8-year period, we added $2 trillion. And in 1 year, we added more than that 8-year period previously. So that's kind of scary to think about how how out of hand this is getting. As far as like the amount of money that we're putting into the system. And people suspect that it'll eventually lead to inflation, but time will tell. But I think the increase in money supply was directly connected to the unemployment rate, because we hit almost 15%, and then we're just around 7%. Which is high compared to past decades, but it's nowhere near that high that we reached. And I think that we got bailed out by the government and the Fed and everything else with those things, but I question how sustainable it is. I'm not sure that it'll be able to last long term, because eventually there's always a correction. Valuations get too high, and a sell-off occurs. And the longer you go without the correction, the more violent it will be. And you can see in the second red line to the right how far we've gone in comparison to the stretch between other recessions, and how much debt we've added. We're creating a pretty massive debt bubble, and we haven't really had to answer for that yet, but I feel like some strong moves may come up in the market that will bring to light the results of this wild increases in debt. It reminds me of the 20s, where there was immense excesses in spending and adding on to debt, and we're doing quite a bit of that in this current period over the last 13 years. So with the increase in debt, eventually there's crunch time and people cut their spending. We saw that in March, because more in April, because that's when a lot of the layoffs happen. If you look at the unemployment, when it almost reached 15% in around April, that's when people were cutting back their spending. People weren't using credit cards; they were switching to debit, and that was just a time where people weren't sure where the economy was going. So I think it's possible that we could return to that, because the support we're receiving from the government, it's not going to be able to be sustained for the long term. They're putting trillions and trillions into stimulus and into the money supply, but eventually the value of the market will continue to get higher, and the bubble will just get bigger before it bursts. So I personally would like to be on the right side of this when it goes down. And we can see that we're already pretty stretched so far. So I feel like a burst in that bubble could eventually occur, and just wanted to pass that along, and that's something just to look out for, because we've gone a really long while with this insanely high debt increase, this debt rate that we're dealing with. It's really something that the government needs to address, because this is unsustainable. Like I said earlier, if we continue this for another 100 years, another century, we're going to have an extra $100 trillion. No one thinks about the long term, but imagine another $100 trillion added to the debt. Eventually something's going to give, and I think we need to get that in order, but it is what it is. All right, later.